Yeah, we'll get started. Like we were saying, it's the middle of the workday. So whether you're here on the West Coast or back east, anywhere in the middle of the country, it's the middle of the workday. So it's absolutely hard to pick the perfect time to get people in for a situation like this. That being said, we very much appreciate everyone who's taken time out to come and spend a few minutes with us, hear about what we're talking about today, and yeah, hopefully we bring some insight and some great points to the table here, some good discussion topics, and bring some value to everyone who's taken time to join us and everyone who's watching back on recording. Of course, we're going to put out a standard disclaimer. We are not financial professionals. We're not offering investment advice. We're simply talking about our opinions in a certain sector of the investment space, and we hope that you find those valuable and provocative. Connecting directly to the image here, we had a lot of questions about our image and why did we choose pigs get fed, hogs get slaughtered? And what does this mean? Does this mean we're just, way low on the stock market and we think everything's going to go terribly and all this other stuff? It's more about the idea that we're seeing some things on the horizon, some trends that may indicate a little bit of choppy water here in the near future. And what we do at BCGK is we invest in the multifamily space. We've been doing it together for about 4 years. We're highly involved in this space. We see it as incredibly resilient, especially in California. Sharp, I know you're going to touch a little bit on how resilient California is and how it bounces back quicker than other areas, even in times of choppy water. So we're here today to talk about how, if you haven't thought about diversifying into real estate, it's probably time to consider that and to look around and compare how does your investment portfolio stack up against the investment portfolio of others out there, and what is your real estate allocation? Are you not in real estate at all, and maybe why should you be? So those are the things we want to talk about today. And with that being said, Greg Sharp, I'm going to toss it right over to you to get started. Excited to hear what you have to say.
Okay, so thank you, Kevin. It is an interesting title. In this case, the pigs are stocks that have done well, and we hope that everybody's done well with their stocks. But with many things in markets or investments, you can let them sit a little too long and you get a little greedy, and that's when you get slaughtered. And that's what we're going to kind of address today. And just to let you know a little about who I am, my name is Greg Sharp. I broker loans, and BCGK is one of my clients. Brandon, the B in BCGK, has been a client of mine. We've been in various businesses together for the past 10 years. I do have about 25 years of engineering and 25 years of real estate in my career. And I've been a developer, broker, general contractor. I'm currently a HUD construction consultant. And I've done about 100 million of my own personal development projects that I managed myself, raised money for, and financed. So today we're going to talk a little bit about the risks in the market, the strengths of the syndications with BCGK, and the concept, the idea of moving strong stock gains away from a possibly volatile market into real estate. Now, the graphic here shows stock market crashes. It doesn't take a full-blown crash to hurt your investments. So we're not looking and talking doom and gloom, but we see some things that we really need to take care of, need to make sure that everybody's aware of, so that you don't sit a little too long with too many gains. So we've put together some polls today, and Kevin, I'm assuming you're going to start the first poll.
Yes, sir.
Wow, looks like I get to participate. Nope, you're not going to let me participate. Oh, must vote. Okay, so there are two polls. One, how much are you allocating into your real estate portfolio? And then there's going to be a second poll that'll be coming along, and that is just how much do you think should be in your real estate portfolio? So out of the whole $100 million that you're personally investing out of your own money, how much of that is going into your real estate, and what do you think it should be? Because this is kind of where we talk about rebalancing a portfolio to make sure when you have success in the stock market, like many people should have had a lot of success recently, your value in your stocks can be oversized relative to the rest of your portfolio, and you want to take some profits off the table.
Greg, great explanation there. I'm going to end that poll. I'm going to launch the other one as well. Let's see.
Okay.
Well, actually, we'll save the sharing for later. It's more to get you to, a thought experiment to look at where you're at currently and what you think would ideally be where you'd like to be. Greg, go ahead and go from there. I'm going to get the second one out.
Okay, very good. Number one, nobody can predict the markets. When 2008 was coming around, my partner at the time and I, we modeled it. We said, it can't be worse than the 1990s crash. And we were doing condo conversions. And the way the crash happened, we were the leading edge of the casualties. It actually happened in July of 2007 for us. The market just dried up and our values were plummeting. Our buyers disappeared. And that was a challenging time. So my crystal ball is very fuzzy these days. But we do see some facts in the marketplace that, on the little cartoon there, you've got the bull market. Everybody's wanting the bull market to run. And we've had some really good gains in the market. But, the bear is waiting in the wings. We have really high stock values. The overall market is not doing as well as certain big stocks. You've got the AI, NVIDIA, all of these tech stocks are doing really well, but the rest of the market are being buoyed up by these massively large companies. Interest rates seem to have stabilized, and we thought we were going to see something early in Q1 for a drop in rates, but there were some factors that they said, we're not going to do that yet. So they're predicting three drops this year, but they may say, we've got some things that, the job market's too strong and inflation is still there. Well, don't know what we're going to see. And consumer spending has slowed. I know people are sitting out there with a lot of credit card debt still. Credit cards, some of them are 29%. And it's an election year. Election years typically are good, but, it depends on how the politicians manipulate it. I have a very dim view of our politicians and how they manipulate data and information to feed to the masses on both sides. Things to watch are the gross domestic product, jobs, consumer spending, and interest rate drops. Those are going to be the additional factors. So you'll see bulls and bears out there every time. Even when it's really bullish, you're going to have some contrarian guy that's going to say it's going to crash. And you just have to, make your own judgment and see what's going on. But there are people out there saying, in February, crash proof your portfolio and do it with REITs. And that's pretty funny because REITs are real estate stocks. But that's kind of for the benefit of the stockbrokers, the insurance agents, because they get paid on keeping you in stocks. Morgan Stanley had one of their analysts saying that dropping interest rates are wishful thinking, which I tend to agree. I broker loans, and a lot of my lenders, when the Fed didn't drop rates, they had to raise their rates up because they were too low. They had priced in the lower interest rate. So they're going to be much more cautious. And, everybody says, I don't know what we're going to see. So people will tell you that it's going to drop, but it's not certain. And you're going to see people like Bezos of Amazon, Warren Buffett, people that own Walmart, the Waltons, they're going to cash. And that's what this Paul Dietrich said, that the market's overvalued. And so when you start seeing signs like that, it's like, okay, since we know we can't time the peak, when do we take our money off the table? If you wait too long, you go over the cliff on the other side, you could hit a rapid downturn because things can move very quickly with the stocks. So getting out a little early is better, and then you can preserve your returns and put them into something like real estate. Uh, Christopher Mullen, he's a chief market strategist for the Technical Trader. This is his chart. And he says, I hope you can see my mouse there, stage 3 where it's topping, he says we're right there. The market is topping out, and you're seeing, kind of like the high net worth individuals that I mentioned in the previous slide, people are going to safe investments, which are cash, gold, utilities, long-term treasury bonds. These are guaranteed yields, though much lower, and people are preserving capital. I had a mentor who financed a lot of my condo conversion projects, and he said, you never lose your capital. Stay in the market, and it's better to wait for your market to come back and keep your capital rather than take your losses, because once it's gone, it's gone. You don't want to make your money twice.
Yeah, Greg, what's that saying? It's hard enough to make money once. Don't make yourself try to do it twice. So yeah,
Yeah.
the idea behind identifying some of these key factors that are happening, saying that indicates a downswing, doesn't mean it's guaranteed. And as we all know, the chart on your stocks ticks up and down wildly. The idea is, while it's on its way shooting up, and we know that it can't go up in perpetuity, because if it did, it would be the easiest investment of all time. Reallocating some of those upswing situations into a more robust recession-proof or downturn-proof asset. Would that be a fair summary?
Yeah, and well, many people investing, they're optimistic. Oh yeah, just I'll let it sit for another couple more days, and that third day is when it drops, and you say, oh, I should have gotten out earlier.
Right.
If you've ever caught yourself saying that, then try getting out a little early this time. Now, once you know that you've got more allocated into stocks than you have normally because of the success of your stock portfolio, you don't want to sell off the entire portfolio. You want to keep some in stocks, but take the profits off. And with that, what BCGK does, they do syndications. And syndications are where basically you get some guys that operate the property. They've managed the whole deal, and the investors are giving their money to them to participate in the profits with the investors. So unlike stocks, when your stockbroker invests in a stock for you, he gets paid a commission on the purchase. And if you make money or lose money, doesn't matter to him. Though there are some flat fee and then some commission-based agents. The syndicators, they're in the trenches, and if they don't make money for you, they don't get paid. So they're more highly motivated, in my opinion, than stockbrokers. And syndications, basically, you're putting your money alongside other people's money, and you're getting a piece of the pie rather than eating the whole elephant. And BCGK already has all their operational systems in place. They've built up some cash reserves to handle extraneous events. Something that happens, tenants move out. You might have a bunch of tenants move out in 1 week, and you've got a lot of renovation to do to clean up the units and release them, and that takes cash. So having enough cash flow is very, very important. And since you're investing, it's going to be a passive investment, so you've got more free time. So if you're a professional, your typical doctors, lawyers, executives, you make more money doing your job full time, and you don't have the time to manage a portfolio. So that's why syndications are good for you, and they do all the research. They know what they think is going to make the most money for everybody.
Greg, I want to just jump in really quickly because you highlighted something I just want to touch on really, really fast that I think is super important. We invest in every single deal, our own money alongside of our investors. And that's so important because you hit on the idea that a financial advisor doesn't stand to lose if you lose most of the time. I know there are some financial advisors and brokerages that are getting a little bit more creative in how they structure things. But in our case, of all the deals we've ever done, We've either owned them outright or we invest literally hundreds of thousands of dollars alongside our investors. So I think that's just a really important thing to point out. Sometimes people don't quite understand that. And it's really something that I want to be at the forefront. We're out there with you.
Yeah.
We're in it with you. We are pro rata shareholders of the deal, just like you are. So thank you for pointing that out. I just wanted to clarify a little more.
Yeah, and BCGK is investing in California in the Central Valley. And that's basically Bakersfield to Sacramento and a little further north. Um, and throughout California, you've got rents are more affordable than owning houses. And if you're in California, you know what housing prices are like. And even though rents are really high, they're still more affordable than uh, buying a house. The problem that a lot of people see is that everybody's moving out of California. U-Haul trucks are at a premium. You can get them almost for free if you're moving to California, but they're going to pay a premium to go out of California with a U-Haul truck on a one-way ride. But if you look at this map, you see California down there. There are some blue sections to the state. Now, this is through mid 2023. If you look at just all of 2023, the southern tip of California is not as blue anymore, and it's really that corridor right through the center where the blue is. That's showing you that there are actually about 10 counties in California out of the 58 that had populations that grew more than 0.5% in 1 year. So over 10 years, that's a 5% growth. That's a pretty good clip. And if you've got a growing population, you have demand for housing, and you can get a premium for good quality properties, and you don't have the vacancies. It's just really good for multifamily investments. And the key to real multifamily investments is you just get in. You get into the deal, and then after a couple of years, when rents have increased, you've got more stability and strength with your property. So if you've got a market that's got a growing population, that's going to be ideal. And
Right.
we looked at this and saw growth in 2022 as well. And it's just fantastic. And people are going to continue coming to California. They love California. Central Valley is not the beach, but it still qualifies as the California dream. You're close to the mountains and close to the water. You can go anywhere and within a few hours and see something pretty amazing. So people like California, and that's why it's going to keep being a populous state.
Yeah, Greg, and we have a fantastic Central Valley deck specifically that talks about the highlights economically of the Central Valley and why we so heavily believe in it. If anybody wants that, please reach out to me directly. I can get you that deck. It's a quick little, 10-page flip through that will explain, really more detail where the Central Valley is, what supports it, its population growth, the fact that it's #1 in the nation in solar and wind projects, all kinds of great things to help support everything you're talking about. The mass exodus that you hear about, yeah, there are people leaving big cities. That's happening all over the country, though, and they're going to places that are more affordable because they can work remotely, because they don't need to be in those urban epicenters anymore. So the Central Valley is exactly what you're looking for in that case, which is proximity to big cities, proximity to industry jobs, all that fun stuff, the leisure that you want without the prices of Sacramento or Los Angeles, et cetera, et
Yeah,
cetera. So
good points.
I'd love to share that deck with anyone who wants it. Reach out directly, please.
Okay. Now, not all of the Central Valley is good. There are some armpits in the Central Valley, and they're just not growing, so they're avoided. Bakersfield is where they've got a number of properties. And while Kern County, which contains Bakersfield, has declined in total population, the city of Bakersfield has actually grown. So that's that part of the criteria they're looking at and analyzing that makes sure that there's going to be a good probability of getting a winning investment. And you can see from all the way from Redding, well, actually, let's say the Sacramento Valley in the purple, pinkish up there at the top, Yuba City, that's about as far north as you guys have been looking, correct?
That's right.
Yeah, from Yuba City all the way down to Bakersfield, avoiding things like I think Stockton, Modesto, Merced, those are not great areas.
Yeah, there's a few undesirable areas or lesser desirable areas, and that's all part of the market analysis, right, Greg? We're looking for those areas where things are growing, where they're proximal to the things that people want to be around. Like, for example, Auburn. We're not going to get too deep into Auburn, but Auburn is a little bit south of Yuba City and a little bit northeast of Sacramento, and is only a couple hours away from Tahoe and some of the most beautiful wilderness that our country has to offer, while also being about 45 minutes away from Sacramento and the job markets that are there that keep people around. So it's this great little gold rush community, and it's got a great mix of of strong income, of a place that people want to live, and proximity to where they need to be. That's what we look for in the Central Valley. So while there are lesser desirable places, there are absolutely, we're focused on the ones that are growing, and those are fairly, I don't want to call it easy to identify, but we've got a pretty good process for that.
Yeah, and I'm an amateur gold prospector, so I like the idea of going up there to look at their properties because I might take some of my equipment and go out in the hills and try to find some yellow
Yeah,
specks.
really work on your ROI that way.
Yeah, it enhances the investment gains.
Sure.
So BCGK is doing a lot of things right. I've watched Brandon for 10 years, and we've all made some mistakes, and Brandon's definitely learning and growing. And every acquisition, they're getting better and better. And they're looking at the right areas, the right bedroom communities of Sacramento, commuter areas. These are sub 50,000 person towns that feed into Sacramento, but they're still growing. There's demand there, and they also do lower leverage on their acquisition loans. So they're not doing the max leverage because they want to make sure that when they start out, they're getting cash flow. So when you've got cash flow coming in, it covers a lot of problems. If you end up having to have a capital call, it's no fun. It's ugly for everybody, and so they're leveraging it just right. Now, California, it requires the higher down payments to actually have cash flow because the property values are relatively high, but you also have high appreciation. So California is an asset preservation play in the real estate market, whereas something like the Rust Belt, the South, Texas, they're going to be really good cash flow, but not so much on the appreciation. And the appreciation is where we really make our money in real estate. So, we talked about California being desirable. I forgot to mention the weather. I lived in Florida. I lived in Alabama. Tornadoes came close. Hurricanes came close. But I prefer the earthquakes myself. And I have a specific plan that I'm working on with Brandon for my investment with BCGK, and doing a lot more with them. So I am committed to what they're doing because I think they're doing it right. And my very first investment property, I bought because I was day trading stocks with the guys at work. And I used my .com stock profits to buy a triplex in Costa Mesa, California. So taking money off the table, you're not doing anything wrong. You're not missing out on profit. You're creating the opportunity for gaining leverage with real estate. The margins that you can buy for stocks is kind of like loans with real estate. You can control a property with 40% of the purchase price, whereas stocks, you control the stock with 100% of the money, unless you're using leverage. But margin for holding stocks is generally, I don't know if you can even do that, but for like day trading and Forex exchange, it adds risk. It also adds gains, but the leverage works up and down. And the stock market, Forex, Bitcoin, all of them can be very volatile. Whereas real estate, we've had some volatile events, but in general, it's a lot more slowly moving, that you have the ability to exit from problem properties and understand a shift is coming, and maybe you sell a property and you take the cash and sit on it looking for a better deal. And so with all of this, we've identified how the market might be indicating a trend. We're pretty confident that it is, and we're suggesting if you've been really successful in stocks that you should consider taking some of that out and putting into real estate, to keep the profits in your bank. And if you haven't made money in stocks, then you really need to exit because it's been pretty good.
Hey,
Uh,
Greg, those are great points. And before I let you go, before I let you wrap, got a question for you from an anonymous attendee here. Can you explain what you mean by leverage?
Leverage. So it's like when you have a pry bar to move a big boulder or a rock or open something. When you've got a long bar, you've got a lot of leverage. So our leverage bar for real estate is the loan. So if I'm buying a property for $100, I can put $40 down and the bank will give me $60. So if the property goes up 10%, it's now worth $110. But I now have $50 in equity because it's worth 110. I put in $40. So I went from $40 to $50. It was only a 10% appreciation in the market, but what is that? 25%. If I'm doing my math in my head right, it's 25% growth in your money that you invested. So that's the leverage that I'm talking about. So loans make your gains much faster with the leverage you have, and I hope that explains it well.
Yeah, I think that's pretty good. And it's also, I think the easiest way to think about it is a standard home purchase, right? You put 20% down on a standard home purchase. We put down at a minimum 30% on our investment properties. And that means, obviously we only need a 70% positional loan. Uh, However, in the current state of the market, we've revised our model a little bit. We're not only putting down 30%, we're putting down closer to 50%. And that's to maintain a lower interest rate, a lower mortgage payment, continue our strong cash flow, and also not be as subject to market conditions. If you have a very large loan and things start to shift, and a number of things can happen, but you've got that large loan and that large mortgage payment with more with leverage on our side. We're not as subject to those conditions because we put ourselves in a very strong position to where something really catastrophic would have to happen before we even started approaching a monthly break even in terms of what we're collecting and our mortgage pay down and expenses and things like that. So I hope those two things combined answer leverage. And Greg, I'll let you go if you have
Yeah,
any final thoughts so that you can kind of wrap.
yeah. One final thought is that if you want to make sure you lose money in real estate, put yourself in an over leveraged position where you've used up all your money to buy all the real estate and you don't have any reserves left over. If something goes wrong and you need money and the market's dropping and you have to sell, that's when you're guaranteed to lock in your losses. But when you have lower leverage loans like the 40 or 50% down payments, then you're not in a position where you're going to be needing cash and you have to liquidate a property and lock in a loss. Because real estate, we have losses all the time on paper, but we don't realize those losses until we sell the property. And the goal is to never sell a property for a loss and to maintain enough control over the property and enough cash so that we don't have to go begging for money somewhere else, because that's where losses are created, and that's how you don't get slaughtered. So Kevin, I'm going to turn it back over to you, unless there are any other questions, or I think they're all going to be for you guys.
I saw a question pop in from our controller, Louis. Louis, how you doing out there? And it was more of a comment than a question. Um, so Louis wanted to point out the tax benefits that we all derive from investments like this as well. And that's a really good point. There are fantastic tax benefits. We don't want to keep you guys too much past 30 minutes. So maybe we'll make that our next webinar topic. That's a really good one to get into and to really spend some time on, rather than trying to fit it all in here. But the idea that there are fantastic fantastic tax benefits to these purchases as well is generally something that doesn't come from other type of investments. Let's see.
And Louis got a lot of experience. He's your controller there for BCGK,
Yes.
and he's a pretty smart cookie. I've been learning some things from him, and he'd be good for one of the next webinars to talk about tax advantages and how we're trying to structure things to make even more gains.
Absolutely. So a few other things. I'm just going to close out all the Q&A here. Not to be political, but is Trump over leveraged currently? That's hard to answer. We don't really know. Don't want to dive into that anyway. Some things are best left untouched. We're just going to leave that one where it is. Somebody else.
And
Greg,
really, that goes back to my question.
sure.
Over leveraged. There's no such thing as over leveraged until you sell.
Yeah,
Who,
absolutely.
so if you're not selling, who cares? It's just paper. But when
Agreed.
you,
Agreed. And like I said, we'll leave that one in the weeds anyway.
yeah,
I said stocks that have generated a loss to me are better getting out of and reinvesting. Based on experience with BCGK, I'm more comfortable investing additional funds with them. Love that comment. Thank you, anonymous attendee, and thank you, Louis. Okay, so guys, we pretty much hit it right on the head here with 30 minutes. We don't want to keep you too long. We want to keep these conversations brief. We want you to be engaged. We hope you gained value from this. If there are any other questions, please do follow up with me directly. You'll have my email. Of course, you have my email already. I'm happy to answer any questions, hop on any calls, talk about this further. I'd love to share that Central Valley deck with anyone who's interested. Honestly, it's a fantastic region here in California, and somewhere that we just continue to believe in. A quick recap of the poll, just for everyone's knowledge. The people were spread everywhere. Some people had no real estate exposure. Some people, there's two people, less than 10%, a couple in the 10 to 25 range, a couple 25 to 50, a few people in the 75 to 100% range. So we've got people everywhere. And then everyone's ideal situation put them in the 10 to 25 range, 25 to 50, 50 to 75, 75 to 100. We cut a few slides out just to, in terms of brevity that Sharp put together, and they were fantastic. I'd like to plug one that I think is just really, really easy as a metric. And that is, Berkshire Hathaway and Warren Buffett's company. They're 30% in real estate. So one of the richest people on earth, who's been one of the most successful investors of all time, has about 30% of his portfolio in real estate at any given time. Just something that we believe in. So the overarching message here that I'll leave you all with is that, yeah, this conversation was about looking at what's happening in the market, how you've done recently in those stock gains, and if it's the right time to diversify by getting into real estate. Again, a little bit more robust, recession-proof asset class, just in case things were to take a turn. We've got a contentious presidential election upcoming, a lot of stuff happening out in the world. You never know when things are going to happen. If you did, that crystal ball would be worth a lot. But it's our opinion that real estate's a great place to be. We're invested there. We're going to keep being invested there. And we'd love for you to join us. The last thing I'll say, we are still funding one current deal that's going phenomenally well. It is up in Auburn, California. It's a 16-unit complex that we're just finishing out the CapEx and reserves budget for. So Sharp loosely touched on what reserves budgets are important for. Of course, that's just your if anything goes wrong budget. We build that into every raise. So the property's been operating phenomenally for the past 9 months. We've got great financials to support, and we're just going to continue finishing out that raise. And if any of you want to talk further about that offline, I'm happy to do that as well. I think that's it. On behalf of my team here at BCGK and everybody, Greg Sharp, Louis, everybody who helps us do what we do, we really thank you guys for coming. We, again, hope to make this a regular occurrence every 4 to 6 weeks, something like that, an interesting topic. We're going to try never to waste your time and always to be engaging and provide fruitful discussion. So I want to thank everyone for attending. Thanks again, Greg Sharp, to our speaker, Greg Sharp. All of his information will be linked as well. So if anyone wants to look him up, speak with him, engage with him more, you can do that as well. Thank you all for coming. We'll see you next time.